You see that? Meow, meow. You awake? Ooh. Come. There you go. Oops. Yeah. We're going to talk about markets. The market can do anything. That's why markets are so fascinating. The market is discounting the future. So if everybody is positive or negative, that may have been discounted in the market already. Are you ready to be a contrarian? See, if you're part of the crowd, you cannot think. And that's why markets have a melt up or a crash. And there is this character trait, fear of missing out, FOMO. That's not the way to make money. The way to make money is when you are able to separate yourself from the crowd. And when you have the courage to buy when nobody else wants to buy. When you have the courage to sell when nobody else wants to sell. Of course, predicting the market is a fool's game because there are so many factors to take into account. You have to rely on your instinct because if you only look at specific factors like earnings or politics or whatever, you may miss the big picture. Besides, markets are moved by liquidity, and liquidity is provided by the central bank. So if the spigots are opened, markets go up despite overvaluation or whatever. And when liquidity shrinks for whatever reason, markets experience flash crashes. And 70% of the trading is done by algos, by robots. Then the robots freeze. So what happened in 2018, especially in December? Nearly 50% of the stocks in the US had a new low. There were lots of reasons why that happened. But one of the reasons was that liquidity was being withdrawn by the American Federal Reserve. Of course, the Fed turned and we had an incredible rebound in January 2019. Everything went back up to the 200-day moving average. And then the question is, what next? Well, it's interesting that the secular bull market in stocks in the US of the last 10 years may not be over yet. It may even have another few years to run. because everybody is cautious, on the defensive. Trillions and trillions of cash are on the sidelines. And especially the retail investor, 70% is negative. So the risk in the market must be very low, despite the fact that there is a risk to earnings. There are geopolitical problems. There are currency and trade wars. The main thing is, the big picture is, that this secular bull market since 2008 may not be over until retail investors are euphoric for 70%, until everybody has this feeling of fear of missing out. We're not there yet by a long shot. In fact, there are some important dates to keep in mind. The American presidential election in 2020 and the centenary of the Communist Party in China in 2021. Very important. So if we're now in April 2019, even if the market consolidates further in the next few months, because there are some uncertainties, as there always are, we could have a summer rally. And then the market may be focused on 2020, 2021, where we could have a repeat of the melt up, the blow off that we experienced in 1927 to 1929. See, a lot of things that have happened in the last few years are comparable to the 1920s. In 1922, we had a collapse of commodity prices, and a lot of countries were already in an economic depression in 22. Well, look at commodity prices. They've declined more than 50% since 2008. And it looks like continuing because the economy is cooling off dramatically. World trade is declining. But we have stimulus in China, in Europe. We have stable monetary policy in the US, and we may have some stimulus later. So suddenly the crowd may realize that the world has not come to an end yet. And then they will put money to work. See, all the big money, the big sophisticated institutions are still more or less fully invested. Do you think that the secular bull market is over when the smart money is fully invested? Of course, part of that smart money went into bonds, of course, because bonds, the bond yields have gone down dramatically when, and their valuation has gone up because inflation is declining. Growth, global growth is disappointing because of the excessive debt that's built up. But the time to get worried may be a few years from now, when there could be a crash after the melt up. after the blow-off. See, in 1927 to 29, the Federal Reserve gave the market a coup de whiskey. That was their form of quantitative easing, their form of monetary stimulus. And then, of course, the smart money could sell. And the very smart money went short in 1929. You can read history. That's what happened. So today, the smart money, part of it has gone into quality bonds, but part of it is still more or less fully invested. Markets are fascinating. And the question is, should you participate in the melt-up if it comes? The problem is that most people will not get out in time. So even if the market goes up a few 100%, like in 27 to 29, most people just do not take any action in time. But the big problem out there, it'll be another few years probably. At some point, something could cause this crash because we've had a 75-year buildup of debt that cannot be sustained. So the biggest risk to this debt is a repeat of the 1930s, of protectionism, of capital controls, of currency wars. So if the Chinese renminbi, which is probably 50% overvalued, ever devalues 50% over a period of time, we will have deflation all across the globe. And that is the repeat of the 1930s. Will it happen? Everything is in place that it could happen. Let's hope for the best, but don't worry about it. There have always been challenges in the world, but human beings are adaptable and they're always looking for solutions. So you can be confident that it won't be the end of the world at all. There could be a next phase despite everything. So, yes, you have to be prepared for chaos at all times. But maybe this is not the time to really get worried. Maybe the secular bull market, especially in US stocks since 2008, has a few years more to run. Maybe the turmoil in the next few months is just temporary. And whatever happened in December last year in 2018. Maybe we won't have a retest of that sell-off. See, markets can do anything. And that's why markets are so fascinating. Thank you, and happy Easter.